if you tie your IP strategy to your profitability, who you are as a company, your core valuation growth drivers, every other part of that conversation goes easily. You got to make sure that your IP is actually protecting the thing that's going to grow your business, right?
Welcome to the CFO Show. I'm your host, Melissa Howitson, CFO of Vena. What if the secret to your company's growth isn't in its balance sheet, but in the ideas it owns? Here to discuss how intellectual property is transforming the way that companies build value is Erin-Michael Gill. Erin-Michael is the founder of M&A firm Genaesis and currently serves as the chairman of a federal advisory committee on intellectual property and trade. He brings a wealth of experience spanning 3 presidential administrations, has advised on over $1.2 billion in M&A and capital formation investments, and is repeatedly recognized as one of the world's leading IP strategists. Thanks for joining me, Erin-Michael.
My pleasure. Great to be here.
Before I jump into some of my questions, can you tell us a little bit more about your company and what is it that got you into IP?
I founded a company called Genaesis to help monetize intangible assets that people sort of didn't recognize were on their balance sheet. My background in intellectual property was very diverse and very unusual. I started out as a patent examiner at the U.S. Patent and Trademark Office, then moved down to DuPont, and then out to California to help a startup out there. And then in 2008, the election happened. And San Francisco was kind of the center of the universe for hope and change. And I got a phone call to be an appointee to help run the U.S. Patent and Trademark Office. And shortly after that, I became an investment banker, helping companies that had really, really strong technology breakthroughs communicate kind of what they're doing to investors and eventually go public. Shortly after that, during that time, there was something called the patent wars, and I was the leading analyst on Wall Street that sort of predicted the dynamics and sort of that happening. Over time, the patent value became a little bit less predictable, and I sort of moved over to these sort of other types of intangible assets. It was around that time that I also got reappointed onto a it's a congressionally mandated federal trade advisory committee on intellectual property. And that's sort of odd because, the intellectual property and trade part of it is not what I do in my day job, but it's sort of the work you do to kind of give back and sort of provide service.
You've been doing that through how many presidencies now?
So that's a little unusual. All right. So I was appointed in the Obama administration, and then somehow I got reappointed in the Trump administration, and I got elected chairman of the committee. And the Biden administration thought I was doing a good job, and I got reappointed and reelected as chairman of the committee. Our job is to advise the White House through the U.S. Trade Rep, as well as the Secretary of Commerce, on all of our trade agreements globally that have anything to do with IP, which is almost everything, unfortunately, and then report back when we enter into certain agreements to Congress to say, did the administration sort of do their job or not with respect to sort of advancing America's interests? And so what's crazy is in these last 10 years, we've advised on, I think it's over $1.5 trillion of the U.S. economy in these trade agreements. So I'm enjoying doing that, and it's just a great way to sort of have a broader impact there.
To say you know your stuff about intellectual property and the value that it can drive would be an understatement, I think.
Thanks.
Lots of people, when they think about IP, they tend to think about it in terms of legal terms. But how do you think about it in terms of how it can help drive business value and strategy?
In a lot of ways, and for a lot of companies, intellectual property is very is boring, rightfully so. It's to be something you don't think about. You kind of put it in the shelf. It's kind of like insurance policies. You got to make sure, hey, do I have my insurance? Yes, I do. I don't want to think about it. until the hurricane comes, right? So there's a lot of that sort of like, hey, did we do the IP thing? Yes, it's done. Okay. And that's, perfectly fine, perfectly normal for a lot of folks. The challenge is when you're thinking about your corporate strategy and your business strategy, your intellectual property strategy actually can inform way, way, way more than that. And when you do it correctly and you think a little bit more strategically about sort of your IP and what it means to be part of your company, that's to some extent the ball game. Because what the IP is supposed to be protecting, like the thing that generates and creates value for your business, right? And when you understand that, you manage it, you monitor it, suddenly you're like, oh, wait a minute. We're now making strategic decisions that are informed by how protectable they are. What's the economic moat that's around our company? How do we make it deeper, wider, stronger? All of that, right? So the question is like, well, wait a minute, it's just a cost center. What are we doing? So there's roughly 4 main categories for how you would sort of understand, look at, and analyze intellectual property. And so we can kind of get into it. But the first one that you just mentioned in terms of driving value is very simple for early stage companies. If you have something that you say is new, right? Something that you say is differentiated, is there some secondary indicator to prove that that's true? Well, when you build a sizable patent portfolio, right? And it says, hey, the federal government's taking a look at this and we're not sure necessarily about the commercial value, but we can tell that number one, it's new. Number two, it's inventive. Like it's not obvious to somebody else that they would have already come up with that. And by having that sort of foundation, an investor who's looking at a business like that is saying, okay, well, I'm not sure if this is a good investment or not necessarily, but I know that there's something differentiated about their approach, their technology, and their strategy. And that can lead to follow-on discussions and hopefully attract investment that absent that strategy, absent those assets, would be a much more difficult conversation. And if I can say to you, hey, Melissa, you've built a great company with a great foundation here, and God forbid your strategy doesn't work, this underlying asset is going to have value for the investors that could be sold separately. That allows you to have a much more honest conversation with your investors, and it levels the playing field a little bit more because the floor value of their investment isn't zero, right? And when that's the case, that's helpful for those early stage companies.
And I imagine it helps in that valuation situation, early stage, not just in setting the floor, but also provides a bit of validation that you're onto something that is new and novel, because otherwise you wouldn't be being granted this.
So 1,000%, like, when you're on the investor side of the table, like everybody, like you're lied to every day. Like every day people are lying. Like that's like 90% of what you see. Oh, this guy's lying to me. To what extent are they lying to me? That's just normal. When somebody comes in and says, hey, look, here is a piece of paper from the government that says that nobody in the history of the world has either thought of this, or a normal person, they call it ordinary skill in the art, a normal person would take a look at this and say, oh, well, this is just an obvious improvement over what's come before. Having that external validation, is not insignificant. And it allows the investors to at least have a baseline to say, all right, it might not be the fundamental underlying asset that we want it to be when we end up transacting and, if we have to, sell them separately, but at least we know that some other set of pretty smart people have taken a look at this and contextualized it in a way to say, here's everything that came before, and it's not this. Okay, that can be useful for the people that are having to allocate capital and make investment decisions.
And so you talked about valuation as one of the aspects of IP, but you mentioned that there's 3 others. So what are the other 3 pillars when you think about it?
So driving the valuation is obviously very important, but there's other things that are just normal blocking and tackling for more mature, sophisticated companies. The most obvious one is simply to protect your products, okay? You've developed a new engine. You're going to sell this new engine to 1,000 different people. That's going to make lawnmowers last for 50 hours or whatever it is. Okay, great. Well, you want to make sure that that particular invention, whatever it is, that set of things that make it unique, are unable to be infringed or copied by, say, your contract manufacturer. When I was out in California, we were making the world's smallest laptops. It was these great little products, and they were manufactured in China. And the joke was, the factory closes at 6 and then reopens at 7. And so the idea of needing that IP to make sure that the factory doesn't reopen at 7 to produce the knockoffs or whatever else was always important. And so making sure that you have your space to sell your products in a way that's meaningful, that's the core foundation for protecting products. So that's number one. What are your products, and do I have IP protecting the unique differentiators? And then when I talk about the differentiators, making sure that the IP matches to those differentiators. If you say that, the engine is differentiated because it's small or cheap or whatever, you can say, well, the reason that is because this IP protects it. If the IP is not protecting it, you got to go back and double check your strategy. So that other pillar is protecting the products. Bigger companies, let's say that you're semiconductor manufacturer, right? And you've developed some new algorithm, some new set of processes that's going to make a chip a little bit faster, run a little bit cooler, right? A little bit more ruggedized, whatever it is, okay? Well, you're never going to be able to own all of the IP around your product. It's an incredibly dense thicket of inventions and innovations done by, in some cases, thousands of companies, right? But what you want to be is in the game, right? To be in the game, you need to be able to cross-license your technology with others. And there's basically the strategy of calling sustaining an ecosystem. So what does that mean? It means everybody that's in the ecosystem that's producing products that's in this sort of entering to these fairly complex cross-licensing agreements. And in those cross-licensing agreements, you're developing IP that might be applicable to a large company like a Samsung or an IBM or whomever. And in that sort of cross-licensing agreement, you suddenly realize, like, okay, we have something that they find valuable. They have things that we find valuable. We're going to be able to initiate a conversation based on asymmetry. Okay. You say, well, what's the asymmetry? Well, if you're a small company and you infringe Samsung one time, okay, there's a certain damage that's allocated for that. If you're a big company and you infringe a small company one time, well, that infringement is going to have 1,000 times more damage, right? The damages are much, much, much larger, right? The impact is much, much, much larger. So there's this sort of asymmetry in terms of like the amount of damage to the size of the company when both parties are using each other's IP. So you can enter into somewhat rational cross-licensing agreements. They're very complicated, and very, very smart people kind of come together to negotiate those things. It's definitely not trivial to do that. But the people that are experts in that field, when they come together to negotiate that, if you have the foundational assets that other companies are going to find valuable, that sustains an ecosystem and enables your company to succeed. Now, the last bucket is one that can have one of two flavors, and that's just to generate revenue directly. All right. You don't have to produce products. If you create some amazing inventions, innovations, whatever it is, and you say this IP is enormously valuable, but it's really, think of it in the context of like the engine thing. Let's say you weren't making an engine, you're making a spark plug, right? And you can make spark plugs that, you sell for $7. And if they're great spark plugs, maybe you sell them for $8. Or you license it to the engine manufacturer, and that engine that used to be, $15,000 to sell, now with your great new proprietary technology that nobody else has, produces more horsepower, more output, lasts longer. That same engine you now sell for $25,000, just licensing the IP and capturing that additional value you're creating, you're on another planet, right? So having a whole business strategy wrapped around licensing, technology, whatever it is, without necessarily manufacturing the products yourselves is definitely a way to go. And there are a lot of products and industries where that makes a lot of sense. Now, what I said, there's two flavors of it. That's the normal, hey, I've got a big invention sort of factory. We're developing all kinds of great products, and this is or potential products for other people, and this is going to be useful. The other side of it are people that simply acquire assets and look to monetize them. And that's where you get into, they're kind of like ambulance chasers. It's like a derogatory term for patent people. They call them patent trolls in some cases. And they're leveraging inefficiencies in the market for suing people in order to collect basically taxes on companies where it's just cheaper to settle than fight. There's actually like a lot of public policy that's designed to stop those sort of bad actors. But that is a strategy that people that generate IP use and can in some ways buoy the value of certain patent portfolios. So if your patents are being infringed by a lot of other folks, some of these types of companies will want to acquire them in order to monetize them by generating revenue directly.
We've talked a lot about IP. There's also intangible assets as well that go along with this. Do you think that people inherently even understand that they might have IP and intangible assets?
So here's the thing. So I'm pulling my microphone so you can hear this. The answer is no. Okay. Like, these people that they think their company is based on revenue, based on earnings, based on these normal traditional metrics. And they don't understand why there's a difference between, one set of valuations and another for companies that on the surface might be nearly identical. And when you have these intangible assets, these real intangible assets, suddenly you can tell a story and explain that one set of companies that might, be getting a 2 or 3 or 4x EBITDA multiple are actually, you should look at them where they're going to get a 10 or 12x multiple. And I was like, what's the difference? It's like, well, there's an intangible asset that's underlying this thing. And if you look at it from an asset-based perspective, the value is on another planet, right? So, there's transactions we've worked on where, a company might have, a few $1 million of EBITDA, and let's say they have a federal contract, a government contract, lasts 3 years, okay? Well, the valuation, say, okay, it's going to have 5 million of EBITDA over a 3-year period. That's $15 million of profit coming out of this asset that, if they sit on their hands and just run out the contract, right? Again, that provides in some respects a floor value for what the value of those assets are. Well, there's similar companies that have 1 million of EBITDA and they've got contracts that go out 15 years, right? That have massive backlogs, right? That are actually enormously valuable because they have stable, predictable revenue from, a customer. They pay in cash and they pay on time, right? To a first approximation. There's always, problems. But at the end of the day, when you look at these companies, not necessarily just for their cash flow or their revenue or their profit or whatever, but instead on the underlying asset that produced that, those financials and whatever, that's on another planet in terms of, hey, we're not a 2x company or 3x company, 4x company. We're a 12x company because we have contracts go out 15 to 20 years in some cases that are insane. In the federal government, it's usually 10. State and local can go out far longer. So that's and really that was, once I realized that kind of laid the predicate for me actually starting an M&A firm like Genaesis.
And would that be the one that is most commonly overlooked, do you think, by CFOs, or are there other types of intangible assets that are also overlooked?
So it's an interesting point to say, when you talk about overlooked, it's like they're aware of it, but it's not necessarily managed. You know what I mean? Like if you say the location of a rental car's kiosks at an airport, if they're close to the terminal, they're more valuable, farther away, less valuable, right? Like people are aware of it, but they might not necessarily think about it in the context of this is a thing that helps drive our margins and our value more than our competitors, right? And they don't necessarily allocate for that, right? It's not an easy thing to put on your balance sheet necessarily. Like, hey, we just kind of bundle it into this goodwill bucket or something like that. And it's not a thing that you actually drive into and say, wait a second, these specific items are driving the goodwill and tangible value of our company. the more we invest in these things will continue to drive that value. So when you're looking at, the old cliche is like, hey, what do you want to do? Hey, we're going to cut costs and grow profit. Really? Thanks for that. Like when you have the cliche conversation, you get that out of the way, you talk about the real conversation and say, well, what should we do? It's like, look, the things that clearly drive the value of our company are these things. Okay, cutting costs and these short-term things are fine. This is the stuff that matters, that investors care about, that our customers care about. We need to be making sure that as part of our strategy, we're focusing on those things.
Two things come to mind. One is the way accounting works for these things is part of the challenge, because these things are not on the balance sheet in the way that you're talking about. But also, really, when you boil it down, it comes down to, like you said, what are the things that are differentiating us or helping us to drive value? And how are we looking at those and making sure that we appreciate, properly invest in them, and hold them dear, and make sure that we're not inadvertently overlooking them and potentially damaging our own valuation and ability to drive the company forward by underappreciating these things.
The critical thing is people, manage to what's measured, right? So if you're just measuring, hey, I got to increase profitability, oh, I'll fire all these people. It's like, well, okay, wait a minute. Maybe that's the right case for, whatever it is. But by and large, if you say, I know that whether it's you do surveys or however you want to go after and understand your intangible assets that are important to your company, right? It could be customer satisfaction. It could be your company culture, for God's sake. It could be scores that you get on surveys talking about how happy a client is in interacting with your team, right? Those items, if you measure those things, say, this is growing the intangible value of our company. This is our reason. This is the reason we can sustain higher margins. Why will people pay more for our thing instead of the competitor's thing? Right? It's a very simple question, but it's very hard to understand, especially if you're a CFO. And I'm going to say, hey, I need to invest a huge amount of money in this new terminals being built, and they're asking for this huge amount of money for us to put our rent-a-car kiosk right next to, the baggage claim or whatever it is, right? And the CFO could say, well, that's outrageous. For half the money, we could be, off lot or whatever, and we could charge less, whatever. But if the value of your company and the reason people go to you is because you can just grab your bags and hit the rental car place, right? Then that unbelievable expense turns out, you can say, well, yeah, we spent this money, but it increased our intangible value over here, because this is why people spend the extra $5 for literally the exact same car, right? It's one of those things that seems very counterintuitive until you start measuring the damn thing. And so long as you measure it, then these decisions become a little bit easier to justify.
For companies that are not traditionally IP focused, how would you suggest they go about starting to build out a strategy for this?
Step zero for these guys that just or just not aware of kind of their background in their industry, start benchmarking, right? So, it's relatively straightforward. Whether your lawyer does it or a business development guy or whoever it is could say, hey, do our competitors have IP, right? Like, do they have intellectual property? Have they filed trademarks? Do they have patents? And sort of what do they have? It was kind of odd recently, well, let's say 5-10 years ago, when insurance companies started filing intellectual property. They started filing patents, and they started realizing that they're actually developing a bunch of innovative new technologies associated with evaluating risk and some pretty complicated stuff. And when they realized that, hey, that could actually be a differentiator for us, we don't want the human capital walking out the door and going to our competitor and doing the exact same thing. We want this sort of IP. Then it allows you to say, you know what? Step zero, this is what our competitors are doing. We're not really doing the same thing. Let's start sort of, developing a set of plans that could allow us to maybe improve where, at least the baseline should be. Again, for companies that don't know where to start, it's always good to just take a step back and say, okay, hold on. What are the folks around me doing? And then see if that changes how you're calibrated on your sort of IP foundation.
Great advice. Now let's move over to those who are a little more sophisticated and know that they have IP. So, and your firm helps in a lot of M&A transactions. How impactful is the IP when it comes to M&A? What orders of magnitude difference does it make?
If you start from pure, just foundational, like go, no go decisions, right? Just on a real baseline level. Okay. If you're a technology company, when I was at DuPont, the very first thing that, a deal comes in, it gets flipped over to the IP guy and they say, take a look, right? What do we think? Is this, this is why we like this thing. Does the IP match? That's, in some respects, the simplest thing in the world. Does your IP match the thing that you're selling, right? So if you're sophisticated and you've got, a whole technology innovation program where you've got inventors and engineers and they're filing patents all day long, well, what they're filing patents on could in many cases be completely disconnected from what actually gets commercialized. Because you can think of like a pyramid, at the bottom of the pyramid is all the possibilities, things that might have value, right? And then they do some level of market analysis, and then they do some prototyping, and they go out, and eventually through a whole series of iterations, you get to that final tip of the pyramid where the product comes out. And you realize way down here at the bottom of the pyramid, the thing that the marketing guy is talking about, well, we've got this unique da-da-da-da. Like, wait a minute, did we ever file a patent on that? The basic blocking and tackling of the guys that already have a program and understanding the disconnect between the things that have already been commercialized and the patents that you filed would be shocking. And so you'd be blown away by how many potential deals, transactions, opportunities end up getting killed at step 0 when they're doing the preliminary review and valuation, right? So that's at one sort of extreme where it's a go, no go decision in many cases. Like, maybe we can just do this ourselves, right? Like we know what they're doing. We know what this is. We're a much, much bigger company. And, it really wouldn't be that much of a pain to design around it, to do something different, because their IP doesn't really cover the thing people turned out to value in the market. So as a foundational level, one extreme, yes, you have to do that. At the other extreme, you have like the deals that we do, okay? Where a company that might only have a few $1 million of earnings has a 10, 12, 15-year federal contract, right? Well, now the intangible asset is the story, okay? It's not about, hey, the benchmark for companies like yours, a 4x multiple with a 1x earnout, and you just call it a day. It's like, no, look at this contracted revenue that's going out over this long period of time that doesn't show up on my balance sheet, obviously. Like that's, but it is confidence, it is risk reduction, it is all the things to say that this company is worth a 10x multiple, right? So it's understanding of saying, if I'm a government contractor, for example, right, and I go back to this intangible asset, there's a million other types of intangible assets just like we talked about. But if you say to us like, hey, the value driver is the location of our rental car places, how many, or the airport thing, how many hubs do you have, how many gates do you have, all those things, right? Tangible assets. If you focus on, before a transaction, maximizing those things. So when's the best time to sell your company, right? Well, right after, if you're a federal contractor, right after you've won some big new award. Say, oh, well, don't you want to, operate for 4 or 5 years and show this history? It's like, well, you could. Or right after you've caught the car, like you could just say, look, I'm going to get, and we're doing a deal. They have over $1 billion in backlog, right? Well, why would you want to wait 5, 6, 8 years to sell when that's going to turn into, 400 million, whatever the number is, right? So for us, the CFO that's switched on to say, hey, look, guys, we did it. Our intangible asset is as high as it's ever going to be. It's game time. Let's talk to an advisor. Let's talk to a broker. Let's see where we would come out in our valuation.
You touched a bit on the due diligence process. What things should CFOs be thinking about in advance to be ready for that process?
This is not something Genaesis does, but this is very important. When you're about to sell your company and you're preparing for that, or if you're buying a company, your M&A lawyer is going to know everything about the core deal, the core deal issues, and that's fine. You got to bring in a specialist for the IP stuff. You have to bring in specialized attorneys, specialized experts that understand all of these. It's an enormous number of tiny little things that a generalist just won't notice. Like, you can have patents invalidated or it'd be a problem. There's a lot of companies where the manager will stick his name on every patent application, right? Like the boss, right? The boss is like, "Well, I was there. Stick me on there." It's like, really? Really? Your general manager has 450 patents? That's just exceedingly unlikely, right? Which could potentially invalidate all these patents that you now need to get reissued, change in ownership, get things signed. Like, there's stuff that is clearly not obvious to normal people, nor should they be. It's not, there's the avalanche of things that you would need to get smart on is just, it would be a waste of every CFO's time for sure. And they jump out a window. So like, let's prevent all of those things from happening. Like, there's just hire the people that understand this stuff backwards and forwards and get the legalistic stuff squared away. On the more strategic stuff, okay, that's where you as a CFO, the business development folks, all those guys can do that, whatever you want to call it, strategy mapping, right? Say our IP strategy is to develop an underlying asset that'll have separate transactional value. Have you done that? Yes. We've got patent portfolio that can protect the core products that we're producing. We got that? Yes. We got some patents that can generate some revenue that are licensed out, and we're not cross-licensing them, and they just end up driving value for us. That's great. Or hey, we have this other portfolio for this product set that's being cross-licensed into a patent pool or something like that. Okay. But the idea is your patents don't exist in a vacuum. They're informing a strategy. You've identified what the strategy is, and you can understand and communicate during due diligence what they are, what they're supposed to do, and if they're doing their job.
You talked a bit earlier about the risk side of this in terms of sometimes it's about protection of the company. What are some of the common areas where you've seen risk evolve unexpectedly for companies, or do you have any examples of risks that folks didn't see coming?
In 2008, when the financial crisis happened, okay, I was at a technology company that predated the iPhone. So at the time, we had developed the world's smallest laptop, all right? And it was designed by people that went on to be like head designer or lead designers for the hardware at Square and at Apple and for the iPad. Like the people that developed this thing were some of the smartest people I've ever interacted with in any context, all right? They developed some of the most amazing technology that has ever been developed. It just 10 out of 10, right? We filed a portfolio of, I think the final number was like something like 80 or 90 patent applications to try to protect all of the different inventions that went into this thing. Well, in 2008, the markets crashed. The market for capital got a bit of a disaster. And we ended up having to try to tell the story to investors as they're ready to raise $80 million. You're trying to raise more to bring this amazing product to market, right? Well, at the time, we had 80 or 90 patent applications, but not granted patents. And there wasn't really a process. The delay of getting patents granted at the time was like, you have your great new breakthrough invention. It was going to take 3 or 4 years to get it granted. And so you sit there and investors come in and say, yeah, I think you've got some great new technology. And if this market doesn't settle down, we'll have to sell those patents. But we have no idea what that value is going to be. We don't know how many of these are real because they haven't been reviewed or granted yet. And so that was actually one of the first things when I got appointed shortly after that company, unfortunately, didn't make it because they, in part, because they should have had this amazing, incredible, alive patent portfolio, had a bunch of pending applications, right? When I joined the administration and I got to write the strategic plan for the patent office, And the first things we put in there is there's going to be a fast track. There's going to be a way for companies like my company that should have succeeded to be able to get patents through the system enormously quickly and then show investors, hey, look, no. We've developed something incredible that now you can have confidence investing us and getting us through this time. So the fact that everybody in theory was doing all the right things, trying to build the portfolio, at the end of the day, when it came time to go monetize, the fact that they were pending ended up, not saving the company in a way that I was hoping anyway that it would be able to do.
I'm sure that made you very passionate as you were taking on that next job because it was near and dear.
Yeah, it was, it was one of those things where people talk about things academically. There's a lot of smart people that get told stuff like, hey, this is it. And then in politics, you repeat what you've been told. When I walked in, I was like, no. This is what's important. And to some extent, when you're talking about any sort of corporate advisor, any sort of corporate executive, when you talk about things that you've heard, that's fine. But when you've lived through something, the key difference is that you can prioritize things. And if you can prioritize things, you can make changes in ways where I don't need to go do a bunch of research. I mean, you do some to make sure that your experience is informed, but you can say like, look, I am that person. I have done these things. I have seen the rest of the world, and I can now tell you without any ambiguity of doubt that you need to produce these outcomes to help the most vulnerable people in America in the business context, because there's such an astronomically small number of people that are actually the inventors and creators that are actually producing the things that other people want to use and develop and grow, that protecting those folks when they're the most vulnerable to some extent is the ball game. And so being able to sort of communicate that and say, look, this isn't some academic thing. This company should have succeeded. And look, companies fail for thousands of reasons. It's not, there was never any one thing. But for the thing that I could control, that killed me from step zero.
Do you have any advice for CFOs on how to communicate the importance of IP and intangible assets when talking with their other executive team, their board, and their investors?
Absolutely. So that part, it goes back to what we talked about a moment ago. Don't talk about IP in a vacuum. Hey, I filed 20 patents. That nobody cares. They'll just think it's a cost center. You spent too much money. Don't do that. Instead, say, we've identified these things as the core value drivers for our company. And here's the protection we have around those value drivers. Here's where we're strong. Here's where we're vulnerable. Here's where I think we need to make some changes, right? If you tie your IP strategy to your, profitability, who you are as a company, your core valuation growth drivers, every other part of that conversation goes easily. But if instead you just do it like hey, the legal readout is, hey, we spent $250,000 on patent filings this quarter. Like, we got to get those numbers down. Well, maybe you do, but like the reality is, like, hey, I protected $4 billion in revenue with only $250,000 of expense to ensure that our profit margins are 30% higher than our competitors. Holy crap, double down on that. Make sure that lasts forever, right? It's framing it in a way, one, that's accurate. You got to first of all, you got to make sure that the sentence I just said is true. like it's not just like hey, let's get more budget for the legal team. It's like, you got to make sure that like your IP is actually protecting the thing that's going to grow your business, right? But once you've sort of lined that all out, then it becomes a very easy conversation to say, look, you told me to, improve margin, increase quantity, this, that, and the other, reduce competition. Here are the steps I'm taking, and we're using IP as a critical tool to help do that.
If we have a CFO listening right now and they want to reevaluate their IP approach, where would you suggest that they start?
So for the folks that are listening right now, the easiest thing to do that takes a few minutes is benchmarking. Back to what we said, if you can start out and say, look, just real quick, top 5 competitors, what's their IP strategy? Just really simple. Are they filing patents? They have trademarks? What do they talk about? What are differentiators? How are those differentiators protected? Really, I mean, if you can sort of understand the companies in your space and how they use IP, that's a great way to kind of, write an email, a short briefing paper, something that just says, hey, there might be something in this IP stuff, especially if there's some sort of, either friction or transaction. Friction being, hey, we just heard that so-and-so sued somebody else for some patent thing or trade secret thing or something like that. Hey, are we squared away on that? Some sort of friction, is a good opportunity to kind of bring it up. Or a transaction. Hey, these guys entered doing a cross-licensing agreement. These guys are now, mass producing X, Y, and Z. That's interesting. Do we have the assets that would allow us to do the same thing? Right? Simple benchmarking, maybe half an hour to an hour, an email, a briefing paper, and then you can kind of set things in motion to talk to your key stakeholders to say, hey, product guys, how well differentiated are we and are we protected? Nice and clean, nice and easy, and it initiates a bigger conversation that hopefully they're going to be, to some extent, excited to have. Because if you're now measuring things that they get excited about, because they presumably are excited about the things that help them grow revenue, help them make sales, it's a very linear and kind of straightforward conversation.
Erin-Michael, thank you so much for joining me today. You always have a way of making IP easy to understand and a little bit fun. So really appreciate your time today. Now, whenever we have a guest on the show, we do have 2 rapid fire questions for them. So are you ready?
Absolutely not.
You're getting them anyway.
No, all right, go ahead. Yeah, let's see. What do we got here? What's going on?
What is your go-to strategy for staying productive during the workday?
So we run our company kind of like tech companies do in a lot of ways, where every morning we'll have like a morning check-in, relatively short. We go through all the deals, all the buyers, all the sellers, and we create lists. And we have our teammates holding us accountable throughout the day for going through those. It's very, very common in tech companies to kind of run those stand-ups. Having that for me, having a team, people, processes that all go together to keep us focused, there no other trick, nothing else works as well as that, for sure.
Holding accountable always works, doesn't it?
Yeah.
And the next one is, what always helps you to turn a bad day around?
If I'm working from home, honestly, the easiest thing is to take 5 or 10 minutes with my wife and kids, just touch grass, take a second and just, completely break away from what I'm doing, take yourself out. If I'm, at work or somewhere else, something like that, going for a drive, like going for a long drive. And we have a bunch of like state and national parks around here in the DC area. Going to one of the national parks, parking 15 minutes, 20 minutes, it makes all the difference. It resets, it recalibrates, take a breath, and then you can get back into what you're doing. But I found with all the other things you could do, taking time and separating yourself out from that thing and doing something jarring, there's nothing better.
Yeah, sometimes you just need to clear your head to be able to get back in it, don't you?
Absolutely.
Thank you so much. Really appreciate you joining me today, Erin-Michael.
Absolutely. It was my pleasure. And I'm really, really glad you're doing this. It's a fantastic show. Thank you so much.
If you enjoyed this episode and want to learn more on this topic, sign up for our free newsletter, where each week you'll get a roundup of exclusive resources designed to help you grow your leadership skills and drive strategic transformation across your business. Visit the CFOshowpodcast.com to sign up now. For the CFO Show, I'm Melissa Howitson. Until next time.